European markets are under pressure today amid a weaker close on Wall Street last night. This amid concerns about rising COVID cases in the United States. But recently, we have seen fresh highs for some of the major US indices. So can the S&P see all-time highs once again, or are we due for a pullback? Joining me to discuss is Rajan Dhall. He's an EU market analyst at Kitco. He's also a coach at Trading College. Raj, good to chat to you. Now, I know you've got a few charts to show us. Let's kick off with the S&P 500. Just how bullish are you?
Yeah, I'm still remaining bullish. There's nothing really giving me any major concerns that this trend is not going to continue as of yet. I mean, we had the spike higher following the Pfizer vaccine announcement. And obviously, you know, we've had this, I suppose, pause, you could call it, after, you know, New York governors and whatnot have closed down schools for a little while. But really, it just gives us another opportunity to enter. Looking at the chart that we've got here, you could see that the previous wave highs where I've got the current support level around 3,542, around that level. So if we are currently testing that level, and if it holds on a smaller time frame, then potentially we can see a move back up. And even if there is a break, I wouldn't really concern myself until the next level on the way down that's closer to 3,400 breaks. Then I would be a bit concerned if that one takes a beating. But at the moment, it's looking pretty good for the uptrend.
So it seems as though the Nasdaq has been a little bit of a laggard. Obviously, the tech sector was one of the key outperformers this year. When we're looking further ahead in a post-vaccine world, for example, do you think that the broader big cap tech sector could underperform, that we could see some of those more traditional sectors come back into play?
Yeah, I think that is the case. I mean, we've seen a good move into some travel companies and some oil companies like Exxon. But I would say longer term, so like going into the 2-year time horizon, that kind of thing, I think those companies are still going to grow. I think this is a bit of an overreaction in things like Zoom. Obviously, Tesla is now listed in the S&P 500, so that's going to attract maybe a different type of investor as well, like people that invest into ETFs that are linked to the S&P 500. So we'll see a bit of a boost and things like that. And, you know, the likes of Facebook, Twitter, they're not going anywhere, are they really? Apple, you know, Microsoft, they're not going to go anywhere. And if the economy continues to improve and move out of this coronavirus pandemic, we'll still see those companies grow, but probably not at the same rate as some of the other ones that we're seeing some of those flows move back into, like Walmart, for example.
So let's take a look at the chart of Walmart. We know that it came out with its earnings this week. It was a beat on the top and the bottom line. It was a bit of an underwhelming market reaction, though. Give us a sense of where you think this stock is heading next.
Yeah, correct. So this is one of the positions that I had been favoring, just generally because the long-term trend that you can see on the weekly chart on the left-hand side has been so strong. So you see, obviously, how high the MACD is and how extended the MACD signal lines are above the zero line. But all we're really looking to do is catch these type of trend line breaks that you can see on the daily in the direction of the longer term time frame on the weekly. So even if this does have a short-term pullback off the back of earnings, because their stores are going to be open again, and they're also attracting a different type of customer because they've got a lot of online customers now, the mixture between the two of them could still mean that it could continue to push in this trend. And obviously, it's one of the biggest revenue earners in the world in terms of, you know, it's got a lot of outlays in terms of staff and, you know, property costs and stuff like that. But generally, Walmart's a solid company, and I would fully expect this trend to continue despite the small decline we've seen post-earnings.
Okay, let's have a look now at the chart of gold, which has been under a bit of pressure amid the rally that we've seen in equity market. We know there's been a lot of ebullience on the back of the developments around a vaccine, initially from Pfizer and then from Moderna. And that appears to be moving investors away from some of the safe havens like gold. We can see that we're sort of in this descending trend line. Where do you see us going from here?
Yeah, so unfortunately, I am a bit of a gold bug, obviously, writing for Kitco and things like that. But I do see this. I do see this breaking to the downside, to be honest. As much as it pains me to say it, I mean, we've got the 200 period moving average underneath where the price is at the moment, and then beyond that, I've highlighted with that rectangle that area that's around 1,750, which is another main area of support. So if we do break this conclusively off the back of some decent volume, I think we could move slightly lower before a longer term view of pushing up to 3,000, in the next 3 to 5 years or whatnot. Because at the end of the day, we're not getting rid of the stimulus just yet. And with Joe Biden winning the election, obviously he's being a socialist or whatever, there's probably going to be more stimulus to come. And that's obviously supportive of gold because of the inflation trade. So I do think it will come back. But I think in the medium term, I think we're gonna have to endure a little bit more pain with this one.
So my colleague Jeremy Naylor has been talking a lot about this key support level at 1780. I know you've annotated this level of 1850. What do you think about 1780 as a key support level to watch? Can you see it breaking below anytime soon?
I think it potentially could. I mean, the issue is that we've got with gold is that the ETF outflows that we're seeing from the ETFs in the States of people rotating into normal stocks again, like, the cyclical stocks, retail, travel, oil stocks like we spoke about earlier. There has to be some rotation in those stocks because they've taken a battering and they're going to recover somewhat. And that's obviously in the medium term not favorable for gold. I think the gold is the place where a lot of investors parked their cash when they were worrying during that particular moment in time. And then also we've got the news from basically the Russian mine, the biggest mine in the world, biggest gold mine in the world. So that's going to add some supply to the market leading into 2021. So we've got to be a bit realistic about our targets here. And I think at 1,750, around that mark, very close to Jeremy Naylor's level, it is a realistic point where I think that gold miners, big gold miners like Barrick Gold, Yamana, they're still making good money there. So I think there is some space for a move lower. But like I said, longer term, I think when we get more stimulus added and, central bankers continue to be addicted to stimulus, we'll see this move back up longer term. But like I said, we're going to need a bit of patience in the meantime.
Yeah, and just in terms of timing, we spoke to a metals analyst, Ross Norman, earlier this week, who was suggesting, like you say, a bit of near-term weakness and then lift off into Q1, into Q2. Does that sort of time frame make sense to you?
Yeah, I mean, this is why I like charts so much, to be honest. They back up the fundamental view. So until we make, a higher low, higher high formation, I know it's obviously we can't say on the chart when that's going to happen. But follow the trends for now until we get signs of a reversal. When we see like a trend line at the top that I've got on this chart, if that breaks to the upside, that's going to be a good signal of timing. So you don't necessarily have to sit here and chart watch, and keep watching gold prices every day for that reversal. Obviously, you can wait for these types of trend lines or these resistance levels to be broken to come back into gold. And that's when I would probably consider the timing. I wouldn't really like to commit to Q1, 2021 or something like that, because, who knows what's going to happen between now and then. If Trump, goes absolutely mental when it comes to handing over power to Joe Biden, we could see this happen earlier, right? We don't even know. We've just got to play it by ear, put your trend lines and your resistance levels on the chart. When they break and it's looking like they've got good momentum backing it, then I would probably come back in.
Okay, and finally, let's have a look at the FTSE 100, which was a bit of an underperformer in terms of the recovery from the first quarter global market sell-off. If you compare it to, say, the DAX, it was recovering, but not at the pace at the German index or some of the other European indices as well. Now, we do have this descending trend line, as you've annotated there, in play, but we have seen a decisive break this month. What does that spell for the price action going ahead?
Yeah, you've mentioned some of those European indices like the IBEX in Spain. They've had some great runs, and the FTSE is now broken out of here. So the reason why I put this chart on is to obviously identify that key break, but we've also got that resistance level to keep an eye on as well. So it's just under that 6,600 level, just underneath there. You want to be watching that one, because if that one gets taken out, then we're really back into a bull market again for the FTSE 100. And also, the strength in the pound following some of these positive kind of Brexit headlines recently. I know we've had a negative one overnight, but just in general recently, it doesn't help the FTSE. So if we do get some weakness in the pound, we could see some acceleration in the FTSE 100 to kind of support that. So it's a bit of a tough one because obviously Brexit headlines, people don't feel like it's going to be supportive of the FTSE 100. But you've got to remember that most of these companies are denominated in US dollars. So for some of the big large cap companies like BP, for example, another giant revenue earner in the UK, HSBC, companies like that, which are quite large market cap companies, they find the weaker sterling, positive.
All right, Raj, thank you so much for joining us as always. And that was Rajan Dhall. He's an EU market analyst at Kitco. He's also a coach at Trading College. I'm Victoria Scholar, and thank you so much for watching IGTV.
For more videos like these, subscribe to our YouTube channel, IG UK, and make sure to follow us on Twitter. We're at IGTV.